Bitcoin's crash was no accident. Here's what comes next: the collapse nobody saw coming. Bitcoin just plunged from a record high above $126,000 to roughly $83,000. A violent 35% crash that erased billions of dollars in wealth in a matter of days. Social media exploded, investors panicked, and headlines screamed that Bitcoin was dead once again. But this time, something feels different. This 2025 crash wasn't random. It wasn't a glitch. It wasn't a temporary shakeout. No, this crash was triggered by a chain of events that had been building for months, hidden under the surface, while the world celebrated Bitcoin's new all-time highs. And what comes next will determine the future of Bitcoin for the next decade. In this video, we'll explore why Bitcoin really crashed, who caused it, and who benefited, why this crash is fundamentally different from previous cycles, how institutions, ETFs, and governments played a role, and finally, what comes next for Bitcoin, crypto investors, and the global financial system. Let's dive in. The setup: how Bitcoin reached its breaking point. To understand the crash, we need to understand what created the enormous rally before it. 1. Record-breaking highs. In early October 2025, Bitcoin surged past $126,000, smashing every record in its path. It wasn't just crypto traders driving the market. It was Wall Street, major hedge funds, pension funds, sovereign money, and institutional giants. 2. SPOTETFMANIA. The approval of multiple spot Bitcoin ETFs in 2024 introduced a tidal wave of institutional capital. Billions of dollars poured in, pushing Bitcoin to the stratosphere. Major firms were buying Bitcoin automatically, every day, creating non-stop upward pressure. 3. Corporate treasuries buying Bitcoin. Dozens of public companies, inspired by MicroStrategy, began adding Bitcoin to their balance sheets. This made Bitcoin look legitimate, like a modern gold reserve. 4. Macro trends. With inflation still lingering, geopolitical tensions rising, and distrust in fiat currencies growing, Bitcoin became the symbol of financial independence. Most investors thought the rally would last forever. But underneath the optimism, cracks were forming. The crash. What triggered the meltdown? This crash wasn't caused by a single event. It was an avalanche triggered by pressure points building up for months. 1. Liquidity suddenly vanished. Analysts at Deutsche Bank warned something important. Bitcoin's rally had become too reliant on ETFs and institutional flows. When those inflows slowed, the upward momentum died instantly. 2. Massive liquidations. On October 10th, Bitcoin experienced one of the largest liquidation events in crypto history. Overleveraged traders were wiped out. Billions in long positions were forcibly liquidated, triggering a downward cascade. 3. ETF outflows. Bitcoin ETFs, which previously pumped money in every day, suddenly flipped negative. Institutions began selling, not buying. That shift alone drained billions in liquidity. 4. Corporate treasury sell-offs. Companies that had been proudly holding Bitcoin started selling to stabilize their stock prices. Some firms faced margin pressures, earnings declines, and debt obligations, forcing them to dump Bitcoin into a falling market. 5. Macro shocks. Global markets turned risk-off due to interest rate uncertainty and geopolitical tensions. Investors ditched speculative assets, and Bitcoin fell first, hardest, and fastest. 6. The Tinkerbell effect. Deutsche Bank coined a phrase: Bitcoin only works as long as people believe it works. When confidence cracks, even slightly, the collapse becomes unstoppable. The fallout. Who got hit the hardest? The aftermath of Bitcoin's crash is brutal. Here's who suffered the most. 1. Retail investors. People who bought at $120,000 plus were wiped out. Many entered during the hype, believing institutions made Bitcoin safer. Their savings evaporated in days. 2. Leveraged traders. Anyone using margin or futures was obliterated. Billions in liquidations turned a correction into a catastrophe. 3. Bitcoin-heavy companies. Corporate treasuries that were overexposed to Bitcoin saw their stock prices plunge. Some had to sell large portions of their BTC at losses. 4. Late institutional adopters. Funds that jumped in late, expecting endless inflows, were caught off guard by the sudden reversal. 5. Altcoins. As always, when Bitcoin crashes, altcoins bleed even harder. Why this crash matters more than previous ones. This wasn't a normal crypto crash. It was a turning point. 1. Institutionalization made it worse. Crypto believers thought Wall Street would stabilize Bitcoin. They were wrong. Institutions don't hodl. They don't believe. They buy when it's profitable, and they sell even faster when it's not. When institutions pulled out, they pulled out billions instantly. 2. Bitcoin is no longer a hedge. During the crash, Bitcoin behaved exactly like a high-risk tech stock. It fell when markets fell. It crashed during risk-off sentiment. It did not act like digital gold. That narrative is broken, at least temporarily. 3. The store of value belief was shaken. Bitcoin's value is heavily psychological. It relies on trust, belief, and momentum. When belief falters, prices collapse, sometimes violently. 4. Regulation is coming. Governments watching this crash will almost certainly introduce new regulatory frameworks. Expect ETF restrictions, stricter reporting, anti-manipulation measures, exchange oversight. This crash may accelerate Bitcoin's journey into a more regulated future. The road ahead. What comes next? Now, the most important question. What happens next? There are 3 major scenarios. Scenario A, consolidation and recovery. Likely. Bitcoin stabilizes between $70,000 to $100,000. For months, long-term believers accumulate. ETFs slowly regain inflows. Sentiment heals. This is the build a base before the next rally phase. High probability. Scenario B, extended crypto winter. Possible. If macroeconomic conditions worsen, liquidity dries up, or institutions keep selling, Bitcoin could fall further, even to the $60,000 to $70,000 type range. A deep winter would purge weak projects, bankrupt overexposed companies, and reset the industry. Not the most optimistic scenario, but realistic. Scenario C, a new era for crypto. Best long-term outcome. The crash forces crypto to evolve. Real utility becomes the focus. Regulation brings safety and legitimacy. Scams and weak projects die. Bitcoin matures into a global financial asset. Institutional participation becomes smarter and more stable. This is the rebirth scenario. Painful in the short term, powerful in the long term. What should investors do now? Here's the balanced advice. 1. If you're a long-term believer, stay calm. Crashes are part of Bitcoin's DNA. Don't panic sell. 2. If you're a trader, avoid leverage. Volatility will be extreme for weeks. 3. If you want to buy the dip, do it slowly, in stages. There's no need to catch the exact bottom. 4. If you're unsure, wait. Let the dust settle. No one ever went broke waiting for clarity. 5. Diversify. Don't rely on one asset for your entire future. Final message. Is this the end of Bitcoin? Absolutely not. Bitcoin is not dead. Crypto is not dead. But the fantasy of a straight line to $500,000 is dead. This crash was a warning. Bitcoin is powerful, but vulnerable. Growing, but still maturing. Decentralized, but deeply tied to global liquidity. The next phase of Bitcoin will be shaped not by hype, but by resilience, innovation, regulation, and real adoption. And those who understand this shift will win the next cycle. If you found this breakdown valuable, hit like, subscribe, and drop a comment below. Do you think Bitcoin will recover quickly, or are we heading into a deeper winter? Stay sharp, stay informed, and as always, this is Felix. See you in the next one.